You've probably flipped a light switch or plugged in your phone today without giving a single second of thought to where that power actually comes from. But the infrastructure keeping our lights on, it is changing fast. Welcome to the EDGAR Brief. Today, we're cracking open the Q1 2026 10Q from Bloom Energy, ticker symbol BE, and we are translating it into plain English. Quick note before we get into the weeds, we're independent, not SEC affiliated, and not financial advisors. We use AI to help summarize these filings so errors can happen. Always verify on sec.gov before making any money decisions. Okay, let's get into it.
I want to hook your attention right out of the gate with this number, 130.4%. In the first quarter of 2026, Bloom Energy's top-line revenue didn't just inch up, it jumped an explosive 130.4% compared to the exact same time last year. That is just a staggering leap for a hardware company. Today, we're going to dig into exactly why that happened, where the cash is coming from, and what it actually costs them to get it.
Here is our roadmap for today's explainer. We'll start with the business model, hit the financial scorecard, check their competitive moat, read between the lines, flag the risks, and wrap up with the bottom line.
Section 1. Welcome and business model. What does Bloom Energy actually sell, and to whom?
They build what they call energy servers, which rely on solid-oxide fuel cells. Now, let's strip away the corporate jargon for a second. Think of this as a localized, combustion-free vending machine for electricity. Instead of relying on a traditional, clunky, and honestly vulnerable electrical grid that spans thousands of miles, a customer can just install one of these units right outside their building. You pump in fuel, like natural gas or hydrogen, and it converts it directly into electricity, chemically. No burning involved. It's clean, it's dense, and it's right there on site. So basically, Bloom is a high-tech vending machine company that makes money by selling the physical machines and then getting paid to keep them running.
And looking at the breakdown, you can see exactly how that money comes in. Out of their $751 million in total revenue this quarter, an overwhelming $653.3 million came from one-time product sales. They sell the massive vending machine up front. Then, they get recurring revenue from servicing it. That's the $61.9 million you see there. They also pull in a little bit from installation and selling the electricity itself, but make no mistake, right now this is a business model totally driven by selling huge, expensive pieces of physical hardware.
Moving on to Section 2, the scorecard. Let's look at the numbers that really matter.
First question, are more dollars walking in the door? Oh, absolutely. As we saw at the top of the show, revenue more than doubled, transforming this from a steady burner into a massive growth story. They jumped from $326 million in Q1 2025 all the way to $751 million in Q1 2026.
But look, revenue is vanity, profit is sanity, right? For every dollar sold, how much sticks before payroll, ads, and rent? Their overall gross margin is 30%, up from 27% last year. That's solid. But the absolute star metric here is operating cash flow. This is the real cash left over after running the day-to-day business. Remember, accounting profit can be fiction. Cash isn't. Operating cash flow hit a positive $73.6 million. That is a massive turnaround from a nasty cash burn of over $110 million in the same quarter last year.
Now, if revenue stopped tomorrow, how long until lights out? Well, they have a massive cash cushion of roughly $2.5 billion, so they can keep the lights on for a very long time. However, that cash is paired with about $2.6 billion in total debt. They're heavily leveraged, using complex convertible notes to fuel this aggressive expansion. It's kind of like having a massive overflowing savings account, but an equally massive mortgage right next to it. Section 3, the Mo check. Why can't a competitor just copy this tech and crush them tomorrow?
Well, yes, they have highly specialized proprietary tech that took years to develop, but their real competitive moat, it's financial. They recently built a massive $5 billion institutional financing framework with Brookfield. Think of it like a pre-approved, practically unlimited corporate credit card specifically engineered to fund AI infrastructure. When a giant data center needs power today and cannot wait 5 years for the local utility to build new transmission lines, Bloom has the product and the multi-billion-dollar checkbook ready to finance the deal immediately. That kind of scale is incredibly hard for a newcomer to replicate.
Let's hit Section 4, reading between the lines. We're diving into the management's discussion and analysis to see what the executives are actually focused on. Management is leaning heavily into the AI data center narrative here. You see AI sprinkled all over their forward-looking statements. Now, we've all seen plenty of companies hype up AI just to pump their stock price, right? But here's the difference. Bloom's actual product revenue jumped 208% this quarter. They explicitly cite a major hyperscaler project in the filing as a primary driver. So unlike a lot of tech companies that are just selling a dream, Bloom's numbers actually back up their excitement. AI demands power, and Bloom is currently delivering it.
Section 5. Red flags. Let's skip the lawyer boilerplate about asteroid strikes and look at the real headwinds.
Buried in the risk factors are some very real right-now warnings. They are flagging rising freight and logistics rates. These energy servers are heavy, bulky pieces of equipment, and moving them across the globe is getting much more expensive. They're also fighting rising commodity prices for steel alloys and rare earth metals, plus serious wage inflation for the specialized labor needed to install these units. If they aren't careful, these costs will completely chew up their profit margins.
In fact, you can already see that exact pressure materializing. Their installation gross margins actually flipped from a tiny 1% profit last year to a negative 35% this quarter. The company says this is due to project timing and milestone execution, but it perfectly highlights their vulnerability right now. Selling the product is incredibly profitable, but actually getting it installed on a concrete pad in the real world, that is currently a money loser.
Section 6. The bottom line. Let's bring this whole thing together.
Bloom Energy is a clean energy hardware maker with incredible, undeniable revenue strength driven by the AI data center boom, and their main thing to watch is whether they can control the bleeding on the installation side. They've successfully shifted from burning cash to generating real operating cash flow, which is huge. But going into the next filing, you'll want to track 3 things: their installation margins, their freight costs, and how quickly they are burning through that debt. Growth is expensive, and execution is everything.
And that's your EDGAR brief on Bloom Energy. This was a translation, not a recommendation. Read the original on sec.gov if anything piqued your interest. Thanks for being with us at the EDGAR brief. See you in the next filing.